I'm going to spend a few minutes today talking about uranium because it is a pretty dynamic space right now. There's a lot going on. I think there's a fair bit of reason for excitement. So that's what I'm going to talk about today. And then we will move into learning about the latest and greatest from the 4 companies that are waiting in the wings. They're all great companies, so I'm excited to do that. So first, uranium. I don't know how many of you have been watching the uranium space, but it has been just a touch exciting in the last 3 weeks. To explain what's going on in the last 3 weeks, what I'm going to do is step back 5 years. And so back in 2016, the uranium market was an absolute mess. There was way too much supply. It was all sloshing around in the spot market. And not only was there the spot market sort of just full, producers were producing too much. They were producing more than demand. So it was adding to the problem every single day. And what I think is pretty cool is that the uranium producers of the world sort of got together and decided to collectively address the oversupply situation in their market. And so, and they needed to do that. The spot price was way below the cost of production. It was sort of working for producers because they had these long-term, long-dated contracts, these contracts that they'd signed back in the last bull market, actually, when prices were high. And so they were able to sell into contract price. So they were still just scraping by, but the actual spot price was way lower. And so that was a problem for anybody without contracts and just a systemic problem. And so what did they do? Well, they collectively closed mines, they reduced output, and they supported sequestering in various ways. So the chart below shows millions of pounds that were taken out of the market. And that black line relates to the axis on the right side, which shows the percent of the market that was sequestered relative to what had been taken out back, in 2016 when this effort began. And so you can see that they really cut into production. And what happened? Well, it worked. Over a 4-year period, a 5-year period, annual production from the global uranium space dropped to 129 million pounds per year from 190. So that's a very dramatic change, right? This collective effort really worked. And the price responded, but it didn't respond in a dramatic fashion. So this is a price chart from, from before that effort began. You can see the price just tanking as the market was flooded and the structure didn't work. And then in 2016, it did, after about halfway through the year, it sort of bottomed, production cuts and sequestering. By sequestering, what I mean is funds, basically, various vehicles got set up to buy physical uranium and just hold it. So they basically just took it out of the market and sat on it. And so that took it away from the overfilled spot market. So there was this slow improvement from, the middle of 2016 through 2018, through 2019 and into 2020. And then COVID hit, which had an interesting impact on the uranium sector. I mean, what really happened was that Cigar Lake, which is a dramatically important mine in the uranium space, it produces almost 20% of the world's uranium. It was suspended for quite a long period of time. And the Kazakhs also reduced their output just by not building new wells. Theirs is all ISR, so they leach the uranium in situ, and that's a well field situation. So they stopped pumping from some wells, they stopped developing new wells. That's a sort of a slow to recover production curtailment there. And the uranium price shot up, which was interesting. And then guess what? Cigar restarted because that was never going to be a long-term cut. And the utilities were still not contracting. So what do I mean by utilities contracting? Well, by utilities, I mean the operators of nuclear reactors. They're the ones who consume uranium. And historically, they have secured the majority of their uranium through long-term contracts. So they sign a deal with Cameco or with the Kazakhs, whoever it might be, to supply uranium, a certain number of million pounds of uranium annually at a set price. And those are the long-term contracts. And the utilities were very uncovered with those long-term contracts, which means that for where we sit right now, when we look ahead, and I have a chart coming up a bit, they have a lot of millions of pounds. That wasn't the most elegant way of saying that, but anyways, they have a lot of uranium requirement that is uncontracted. So they have been picking up uranium to fill the gap in the spot market, but that spot market is getting emptied out. So that sort of, in a very condensed manner, brings us up till what happened in the middle of August. And what happened in the middle of August is something that had been setting up over the previous 6 months, which is when Sprott, which is a group that has established quite a few physical commodity trusts. So they have a physical gold trust and a silver trust. So they like creating vehicles that give investors of all natures, from passive funds through to retail investors, the ability to invest directly in a commodity by holding that commodity and letting the investor buy. So what they did was they took over what's called uranium participation, which was a fund that was sort of that nature. It was a physical uranium vehicle, but it was very limited in what it could do. It was not particularly large. Its internal rules very much limited how much it could buy, sell. It was not a dynamic force. It was very passive and it was quite small. So Sprott took it over and turned it into a giant, is sort of the easiest way of saying it. They took it over with, they wouldn't say this in their prospectus, but they took it over with an intent to turn it into a bull force in a market that they thought just was smoldering embers that needed a spark, right? It takes time for all of these things to happen. So they took it over in April. All kinds of deals had to close. Then they had to get the green light to start their at the market financing, right? Which is the kind of financing where you can just raise money up to the max that the ATM facility allows by letting investors buy shares on a daily basis, the amount that the customer wants to issue. So on August 17th, they got the green light and they launched their at the market financing, and that was for $300 million US. So, a reasonable size financing for sure, especially in the uranium space, which is not a very large space, let's remember. And they did it. In 3.5 weeks, they raised 245 million. And the structure of that SPUT, that's, the acronym there, the structure of SPUT is that they plow almost the vast majority of the money that they raise, they plow straight into buying physical uranium. And so that had some significant impact on the price. I'll show you some charts, I think, in the next slide that show what that did to the price. And then on September 10th, far sooner than I actually thought was going to be possible, I knew they would want to upsize their ATM. I didn't think that the regulators were going to move that quickly, but apparently they did. And on September 10th, they upsized their at the market financing to 1.3 billion. So not a small increase. They added $1 billion of capacity in their financing. And so since August 17th, as of yesterday, I think they had purchased 8 million pounds of uranium and sequestered it. And that adds to the amount that uranium participation already had. So they now have a pretty significant stockpile, but they're going to keep buying. That's why they added $1 billion to their financing capacity. And I mentioned sequestering before. So SPUT is not the first by any means vehicle to stockpile uranium as a bet on, and to be blunt, as a way to help create higher uranium prices. But it is by far the largest. And it is large, and it is coming at a time when it appears that the market is really ready for it. So I have these two. The only chart I could find that showed SPUT's financing, like how much money they had taken in their ATM, only goes up till the beginning of September. So that's why the financing chart is much shorter than the uranium price chart. But you can see how they're moving so in tandem, right? As soon as SPUT started pushing money into the uranium market, guess what? The uranium price started moving. So when they started at the beginning of August, uranium was at just about $30 a pound. It's at just about $50 a pound now. So that's a very dramatic move and not very long. And they haven't even deployed half their money yet, right? They still have $750 million left to deploy. So the timing's good because of all of that work that uranium producers had already put into cleaning up the market. It's also good timing because there's a fundamental shortage. There is persistently a shortage. That shortage is usually made up by secondary supplies, which has largely been this spot market with all the excess that's floating around. And then these things called shadow inventories, which are, as the name implies, quite difficult to count, like whether Japanese utilities have a whole bunch on hand that they are slowly selling back into the market. It's sometimes hard to know what those numbers are. So that's the secondary supply that has been filling the gap here that you can see that's between production in yellow and demand in green. But because production has been pulled back so much, it's rising a little bit. But I mean, there's a 62 million pound gap in production this year alone. And if you add together the gaps for each year going forward, by 2025, we're short 200 million pounds. By 2028, we're short 334 million pounds. There's a lot of gap here. And remember, the uranium price was way too weak in recent years to incentivize much in the way of project development. Certainly, companies who were expecting the uranium market to turn around kept moving ahead, just as proactive management teams do in any commodity, right? During the bear market is the time to position yourself for the bull market. If you wait until the bull market, you're probably going to be too late to actually have a product to feed into the demand. So absolutely, there are companies out there, especially US in situ leach operators who are ready to feed into the market. But the amounts that they're each feeding are not 205 million pounds in the next few years. So there's definitely a gap. And here's one way of representing. I mean, uranium is a reasonably opaque market. So I always have to steal slides from the various, the UXC, which is the one data provider for the market. They do a good job. And then different uranium issuers, graphically represent that information in different ways. So I will admit that I borrow all of these slides from them. And this is a representation of those utilities and how many contracts they need to sign, how many pounds they need to ink contracts for, so that they don't run out of uranium. And so the chart on the left shows total requirements, and you can see that requirement rising from right now. It's 160 maybe million pounds a year, and it rises to 220 million pounds a year by 2035. And that's because there are lots of reactors being built, and they're bigger than the old reactors, and so their needs are significant. The yellow bars show you how many of those pounds are uncommitted at this point, as in they are not being provided for through contracts. And so it would be a very, very strange market if all of a sudden utilities decided to buy all of those millions and millions of pounds in the market. And one of the reasons that would be very weird is because utilities don't have the option of running out of uranium, right? For one, they have to secure their supply several years in advance, because then they have to take the yellow cake and turn it into the very specific fuel that their reactors take. Not surprisingly, uranium reactors are quite particular. So whether it's pellets or rods and the exact engineering of those pellets and rods, they need to start that process well ahead of time. They need to turn the uranium into exactly the right quality, and then they need to turn it into exactly the right shape. So they need to get their uranium ahead of time, and they don't have the option to turn their reactors off. So they don't have a choice of running out of uranium. It's not like just turning off a natural gas power plant or a coal power plant. Those can just be turned off. You can't do that with uranium. So that's why we call uranium demand inelastic. If the demand is there, it has to be filled. And that's why, to be honest, uranium utilities have historically acted like lemmings. Once one starts contracting, they have generally piled into contracting because they don't want to be the one left without the contract for their hungry reactor. The chart on the right shows long-term contracting, and you can see that there was a whack of contracting right during the last uranium bull market. So in terms of how much utilities are paying for the uranium that they need for their reactors, not a smart move, but it is a very classic move in the uranium space, which is they go along, oh, there's enough supply, we don't have to worry about it. Oh my gosh, okay, there's a bit of a gap looming. We'll deal with that when it happens. We'll deal with it. Hey, Joe's dealing with it. Hey, Susan's dealing with it. I better deal with it too. And then they all pile in and sign contracts. And that's why there were so many contracts at very high prices that persisted all the way through the bear market. And that's a very likely scenario right now. And the reason that those prices were so high when they all signed during the bear market, chicken, egg, I don't know exactly which way to describe it, but when uranium goes, it puts a gold bull market to shame. Like I said, utilities have to secure uranium, so they all pile in. Speculators have seen this playbook before, so they add to the pressure. And it's just a small market, so that means big price moves, right? There's hardly anywhere for all the pressure to go, so it goes up. And so this is, there was a uranium price spike in the 80s. There was this incredible uranium price spike in the 2000s. And we are just at the beginning, I think, of the next iteration of that. I do want to emphasize that the uranium price absolutely goes up. That previous chart showed, 14, 12-fold increases in the uranium price. Equities do that and then some. And the reason is primarily, it's not really about leverage. When we get a gold bull market, gold producers, or a copper bull market, the leverage that we talk about is because assuming producer prices, like the amount that it costs them to produce an ounce of gold or a pound of copper, assuming those costs stay reasonably stable, that every dollar that the price rises goes straight to profit, right? And that's what leverage is about. It's about increasing profit for producers in a bull market. That's not really what leverage is about in a uranium bull market. In the uranium bull market, what leverage is about is the fact that there's hardly any stocks. The uranium market is tiny, especially after there's been so many hard years in this space. There are literally only a few dozen uranium stocks out there. Like, they're very, very few. So every investor who decides he or she wants exposure to uranium has to go into those few stocks. And of course, they can also choose the spots, the exposure to physical, which are now available, which is great. But that limited option, the limited number of options in terms of stocks is why you can get some absolutely ridiculous returns. On this chart, I'll note that Cameco, during the bull market that's here, this was just the last one in the 2000s, Cameco was the world's largest uranium producer. It gained only 330%. But, it was put to shame by some of the other ones that happened to attract a little bit more of that investor excitement. And I will add that I think there's a factor that adds to the pressure that could add to the pressure this time around. In previous bull markets, passive funds didn't have any way really to play uranium. That uranium participation, the physical uranium trust vehicle thing that existed before, it was not a good proxy for the price. It lacked liquidity. It was not really an option for big money. And miners had a bunch of issues. They were political. They carried a lot of debt. But now this new Sprott physical uranium trust provides a platform for passive funds it has all the liquidity that you can want. And as we all know, passive funds exceed the capital managed by active funds by a lot these days. That's also changed since the last bull market. So I think we're looking at a situation where the algorithms and computers that manage passive money can now play the uranium bull market as well. So I have no idea what impact that's going to have. I don't know if we'll even be able to quantify it when it's all said and done, but I think it's an interesting factor to consider. To end, yes, uranium has moved a lot. It's gone from $30 to $50 in the last month. A bunch of stocks have already gained hundreds of percent, or maybe not hundreds, but yeah, they're up a lot. I added to my positions this week. I do believe that the gains are just getting started. Past performance is no guarantee of what's going to happen next, but I do think that there's a lot of room yet for uranium equities, for the uranium price to go, because remember, SPUT still has $750 million that it will put into buying physical uranium. And we know what less than half of that has done already to the price of uranium. So if you like this opportunity, how are you supposed to play? Well, buy any uranium stock that's still alive. I mean, I joke, but I also don't. I mean, if a uranium company actually survived this bear market and has a real business plan, right? Real people, a real business plan, whether that's exploration, development, production, as long as it sort of passes the basic tests of having a real business plan, then the bear market kind of did your due diligence for you, and you just need to buy a uranium stock. For what it's worth, the ones that I own are listed here. I have Uranium Energy, Denison Mines, NextGen, Fission, ISO, and Valor. I'm happy to answer questions either here or by email later about the details of those stocks. I don't even plan on covering the details of those stocks in a lot of detail in my letter. I plan on covering the uranium market as a whole and assuming that all of them are along for the ride. So that's what I have to say about that. That was a lot of backdrop and current information in a short period of time. Hopefully, some of you at least were interested in uranium and found that helpful in understanding the craziness that is underway right now.